All right, so thanks everyone for attending this webinar. If you're watching a replay later on, just know that this is essentially a project presentation regarding the El Paso Edgemere self-storage project that we're doing. Super excited for you guys to be here to learn about the project. Now, why should you pay attention to this? That's because this is an investment opportunity. So if you are looking to invest in self-storage without actually getting into the industry, without doing any of the work, if you're looking for a passive investment opportunity, this is the presentation that you want to listen to and that you want to pay attention to, because at the end of the presentation, you're going to have a really good idea of the project we're doing. You're going to have a really good idea of the business plan that we have, as well as the exit strategy of what this project is going to end up being. So essentially, the opportunity that we're presenting here is we currently have this 4 acres of lot under contract in El Paso, Texas. We're looking to build a state-of-the-art, temperature-controlled, multi-story self-storage facility that's going to be branded CubeSmart. It's going to be managed by CubeSmart, and it's going to have a fantastic exit potential for everyone that's involved in the project. Now, a couple of disclaimers before we officially begin. We're not offering any legal advice. Do your own due diligence, and you definitely want to consult with your own tax and legal team. This is simply just a general information overview. We're not here to solicit anyone. This is simply just to share this opportunity with those who qualify as accredited investors. Now, to give you a little background of where my team and also my wife and I came from, we used to work in Eastern Canada in the multifamily space. So multifamily was the asset type that we were aggressively going after. We turned property that looked like that into something like this. We'll essentially work with local contractors, doing the renovation on the units that we have and provide them as affordable housing units for rent to the local community. How we used to work with joint venture partners and also passive investors is really as such. So instead of buying, a condo in the primary market, we'll partner up together and buy a multifamily unit, a small multifamily in the tertiary market in Canada. So if we're buying the fourplex at $340,000 as a purchase price, that means for Thomas, he's really putting in around $100,000 in cash in total. So that's how much money he has invested into the deal. After doing about 5 months of renovation and getting new tenants in, we're able to push the new valuation to be around $540,000. We then will go back to the bank, do a refinance, and then that cash out refinance portion, completely tax-free, we're simply restructuring the loan. We're able to get back $160,000. Now, what that means for Thomas is that he's able to reimburse himself with the $103,000 cash that he invested, plus a little bit of profit on top. So what that means for Thomas is he has no money left in the deal. We're able to pull all of his money back out from strategic renovations and from a refinance. Plus, he has a cash flowing fourplex that generates over $1,000 per month in monthly cash flow. Now, we did that model over and over again. So talking about our track record, we did that for 6 plexes, we did that for 8 plexes, we did that for single family rentals that we repositioned to be a short-term rental. So the sellers were happy with us because we're super easy to work with. We gave them a way out. We gave them a very easy exit from the situation that they had. And the investors were extremely happy too. You can check out the happy reviews that we had. If you Google our name, Meily Investment Group on Google, you're going to see all these fantastic reviews that investors have left us. Now, in order to target more opportunities in Eastern Canada, we even did TV commercials. We were part of different groups. We got ourselves accredited. We were featured on different podcasts in regard to the approaches that we had, and also how we're able to create win-win situations with these rental properties. Now, that's how we felt. Our entire team felt like it was awesome. We were keep on scaling up, and we were essentially building our portfolio that's gonna benefit everyone that's involved. However, our property managers started to deliver bad news to us. We're starting to hear about mold issues that started to pop up in some of our units. We had tenants that would leave junk behind, they'll leave the fridges in nasty conditions. We also had a roof leak in one of our units. One of the tenants also set the kitchen on fire by accident, right? So, and that's a brand new cabinet that we had just finished renovating. After about a month into their tenancy, they had they essentially accidentally set the kitchen on fire. We also had the police raid one of our units. We had short-term rental guests, complaining about long-term tenants, and vice versa. So we felt like it was extremely stressful. The more we scaled, the more multifamily units we acquired, the more headaches we're going to have to deal with. So that's really, how we made the transition into self-storage facility. Because at the end of the day, how we see it, it's extremely similar to multifamily in terms of underwriting, in terms of the investment principles. You're getting that principal pay down, you're getting that market appreciation, and the revenue that you get, that's able to cover all of the expenses plus more, right? But what's really cool about it is the fact that it's just like multifamily, but a lot more scalable and a lot more maintenance free. So the Edgemere, El Paso Edgemere project that we have, some of the key characteristics of this project is the fact that it's a ground up development. Because we're building from the ground up, there's a lot of upside potential, meaning that through our exit strategy of selling to an institution, we're able to see a lot of upside in terms of how much we can actually get the property sold for. And let me just focus on this. So it's not focused on cash flow, right? We're not buying a property that already is operating, that's already generating income, and we're improving it. That's not what we're doing. The focus of this deal is very much focused on that equity gain. We're not going after the cash flow, right? So if you're looking for a consistent and dependent cash flow play, if you depend on the cash flow that your investment generates, this is not the right opportunity for you. If you're looking for a self-storage play that's going to generate a lot of equity for you at the end of the term, this would be the perfect opportunity for you. Now, the best part about this self-storage project is the fact that there's no kitchen we have to worry about, there's no appliances, there's no human tenants living in there and smoking in your units, and there's only one toilet we have to worry about. So the plumbing is super straightforward, and we don't have to go to Home Depot to pick out the tiles. It's extremely straightforward. It's sheet metals and concrete. That's what we're working with. From an investor perspective, the targeted returns that we're going after is we're projecting a 16.5 to 23.4% IRR, the internal rate of return, for 5 years. So every single year, for 5 years, we're able to generate this much in return on your money. And the equity multiplier, you're looking at 2.0x to 2.6x. So that means if an investor were to invest 100,000 at the end of the 5-year term, after earning about 16.5% per year, they're able to double the money they have put in. So 100,000 in, at the end of 5 years, it will be around 200,000 back out. Now, if you look at it from a deeper level, what we're doing here, we're raising $4.15 million for the deal. That's roughly around 30% of the total project cost. So from an investment level for each individual investors, we're seeking minimum investments of $50,000 per investor into this deal. Now, how we're setting up the structure, the return structure, is we have an 8% preferred rate of return, and then a 70-30 split. Second hurdle rate set at 18% IRR, and the 60-40 split after the 18% IRR. For those of you who might not be familiar with the concept, don't worry. This is a very simple explanation, and I feel like this is probably the best way to explain the waterfall structure. It's the fact that when we have that sale event, when we sell the property, the first payback is that principal payback. So if you invest 100,000, your 100,000 gets get paid back out first out of the capital stack. And then the first 8% of the deal goes straight to the limited partners. So that's going straight to the investors. That means the first 8%, our investors have access to that directly. So if our project for some reason performs at 8% or under 8%, the general partners, meaning the operating partners in this deal, we don't get any upside benefits from this, right? So from 8% to 18%, every single dollar of profit that we make, 70 cents out of that dollar goes to the limited partners and 30 cents goes to the general partners. After 18%, that's where we have 60-40 split, right? So that's essentially the model that we have that prioritizes the returns for our investors, but at the same time, it incentivizes the general partners, aka the operating partners, to perform better than the projection. This is how we are so confident in the deal that it's going to generate over 18% IRR, that we're only taking a bit of an upside if it performs better than the 18% benchmark that we have set out. Now, the syndication model itself, right? We are the general partners. So Meily investment group, along with our co-GPs that we have put together, it's a power team that we put together. What we're doing is we're actively operating the asset and executing on the business plan. We're contributing our expertise, our resources, and also our own capital. Lynn and I, we have put in over 100,000 of our own money into this venture, into this deal. So you better believe that we're going to see it to the finish line. We're going to make sure that this project outperforms because we have money in the game as well. We have skin in the game. In return, we get equity and we have fees. Now, for the limited partners, what it means for them is they get to passively contribute capital, and that's really the only thing they're bringing. They don't have to dedicate any time. They don't have to do any of that, but they have the preferred rate of return. They get dividends, and they also get equity. They're also fully protected from liabilities. We're running this facility in the US, in El Paso, Texas. There's a lot of uncertainties when it comes to the day-to-day operation. If someone were to have a slip and fall, they have every right to sue the property, but limited partners, aka our investors, are shielded from those liabilities because they're investing to the limited partnership structure. Now, the team that we have put together as well, it's extremely impressive, and we're in a unique position to bring this project into the finish line. Now, between me and Lynn, we have over 4 years of real estate experience and management experience. Lynn is a licensed real estate agent in New Brunswick. I also received my education from the Appraisal Institute of Canada. We together own about 38 doors in multifamily in Montreal and also New Brunswick. But we realized we can't do this alone, right? So we brought on other team members. Gabriel used to serve on the Quebec Securities Commission for 8 years. And he was also a CPA at KPMG, which is one of the big fours. We're also working with Roderick, who has experience in corporate strategy and financial analytics for some of the biggest retailers, such as the Hudson Bay Company in Canada, as well as Restaurant Brands International, which manages Burger King and Tim Hortons. Now, we also get to leverage self-storage and construction industry veterans as well. So Joe, Brian, and Barry, these are some of the other co-GPs that we have on the team with us. So Barry has over 25 years of experience doing commercial development, design, and construction, specifically in the self-storage space. So he's done this for some of the biggest REITs, such as CubeSmart, such as StorageMart, and he does that as a consultant. He has his own consulting company, and he does it as a career. Now, we decided to bring Barry Young as one of our GPs because we want to make sure that we have the top industry people to turn this project into a reality. Joe used to serve in the US Navy. Brian and Joe used to run a very successful flipping company, and they together are in the self-storage space as well. They have about 12 projects on the go at different phases, and they also manage a $50 million self-storage fund out of New Jersey in the US. Now, the project that we have going on, essentially, we have a piece of dirt, right? We have a piece of dirt that already has the entitlement for it. So we're looking to close on the land. We're looking to construct a self-storage facility on the plot of land. And then we have different exits, right? We have the exit potential of even selling before we even finish the building process. We could sell it as CO, meaning that as soon as the project is finished, as soon as it opens up, we have the opportunity to sell it and exit during that point. We can also sell it during the lease-up phase. We can sell it as a stabilized asset. So the fact that we have different points of the exit, it gives us, as the operator, a lot of flexibility in terms of when to choose the exit and when to exit to maximize the internal rate of return for our investors. The market that we go after, the reason we came across El Paso is the fact that these are usually the criteria we look for. We look for markets with really strong job growth. We look for net out positive migration. We look for a really strong storage demand. From a self-storage perspective, we want to make sure that it has very significant rent growth across self-storage facilities as well as multifamily residential. We want to make sure that this market is seeing tremendous income growth and that the economy of scale makes sense for us as operators to keep on scaling up within the same demographics, within the same market. So by leveraging legacy team, they were actually the one that came across this opportunity, right? So they have a very extensive process. I'm showing you the internal board here, but this is the process they have to even find the land, right? The most important part is finding the land that checks all the boxes for us, and that's usually the toughest part. So when they came across the land and when they shared this opportunity with us, what we really value is the fact that it's on a major street called Edgemere Boulevard. If you go on El Paso, if you go on Google Maps and look in El Paso, you're going to see this is one of the major roads that connects west to east. And you're able to see that we have really strong drive-by traffic, extremely excellent visibility from the road, and very easy access for our potential customers who are getting in and out of the site. Now, we identify El Paso to actually be one of the safest large city in America. We found out that El Paso is actually ranked as the third safest city comparing to other cities in its size. We also saw that population-wise, it's seen tremendous growth over the past 10 years, and we're expecting the same amount of growth over the next 5 as well. Part of the reason for that growth and part of the reason why it's such a stable market, and you see that steady population incline, is because we have one of the largest U.S. Army base right here in El Paso called Fort Bliss. We have active duty members, we have family members who are accompanying the active duty members, and we also have over 1,000 reserve members who are serving in the U.S. Army living right here in El Paso, Texas. What we love from a self-storage perspective, and that's for those of you who understand self-storage a little more, you will see the square foot per capita is sitting at 2.55 square foot per capita in the 3-mile radius. We only see 2 other competing stores, so 2 other competitors sitting in the same market. But in this market, as we define it, there's 57,000 people living in there. Now, as a comparison, this is what a site that we looked at in Houston looks like, right? So the same amount of population living there. However, there's 16 other stores that are serving the same market. So it's extremely oversaturated for this site in Houston compared to what we have. For the same amount of population, there's only 2 other stores servicing the same market. And for that site in Houston, there's 16 other stores. The square foot per capita as well, that's where you see the key difference. There's 17 square foot per capita in that Houston market versus when we have 2.55. So we thought, okay, this was interesting. It passed the initial sniff test. So we decided to order what's called a feasibility study. So we hired a professional consultant to look at this site for us, right? We pay him for 5 weeks of his time. And he actually traveled all the way to El Paso to study the demand. So he found out that the 2 competitors that I told you guys about, they're sitting at anywhere from 98 to 99% occupancy. So that means if you live in El Paso in that 3-mile radius, right? If you live in any of the zip codes here, you're going to have a hard time renting self-storage unit because they're fully booked out. And when you look at this further, if you compare it to the Texas saturation times the population, so 8.22 square foot per capita times the total population, you're going to have a total demand in the market that's needed. So that's around 844,000 square foot of self-storage square foot that's needed in this market. However, there's only just over 100,000 square foot. So we are in the excess demand of over 700,000 square foot of self-storage that's needed for this market. So to turn this project into a reality, we're working with Barry Sherman. So as I said, he has over 25 years of experience doing this from A to Z. He has projects all across the country. And this is a project that recently completed in New Jersey. So on the right, that's what you see being the temperature controlled multi-story storage, right? On the left, that's where you see drive-up. So, you see those garage door, that's 1 unit, 2 units, 3 units, super straightforward, super easy to put together compared to what the multifamily building will look like. Here's just some of the other pictures of what it looks like. And that's the very project as a finished product, right? So the only difference here between the 2 pictures are really just, they ended up paving the road and now it's a fully finished product. So they have your parking here, they have the rental office on the first floor, and your multi-story climate control building that's right next to the drive-up units. This is the ribbon cutting ceremony they had in New Jersey. As I said, it's fully branded with CubeSmart. So CubeSmart's property manager and the executives were also present during the ribbon cutting ceremony. We're looking to very much repeat the same process, repeat the same model for our El Paso, Texas site. The reason we're working with CubeSmart, we see that the fact that they're able to project a revenue projection over the next 7 years. We see that being extremely helpful for our underwriting process and also for our investors to understand how well the project is going to perform. Now, you might be thinking, where do they get the data from? They're able to have this data because they currently have CubeSmart locations in El Paso, Texas right now. So they're able to determine how much it costs to, from an HR perspective, to run the facility of this site, what the utilities are, the total marketing cost that's expected, as well as the lease-up velocity, right? So they know the speed at which they're able to lease up all of the units we're looking to build. By partnering up with them, we get to leverage a lot of the brand equity they have, the infrastructure they have, but at the same time, their marketing budget. So they spend millions of dollars on SEO and also Google Ads, paid ads. So what's really interesting, if you Google self-storage near me, you're not going to see Martin May self-storage on there. You're going to see only REITs and these bigger facilities. So by partnering up with them, we're able to tap into the marketing budget they have. That's going to benefit, that's going to bring traffic into our site. And if you go on CubeSmart, you're going to see they already have a bunch of sites in El Paso. It doesn't mean they own them. It just means they're the property managers. So what's going to, our site, the Edgemere project is also going to be on here listed. And when people are looking to rent a unit from CubeSmart, if they live in proximity to our location, they're likely going to come to our location to rent it. So they have their SOPs, they have their team set up, they have their entire systems built out, right? They run this as a publicly traded business. So we get to leverage their SOPs, we get to leverage their team, their branding, but at the same time, they have supplementary revenue streams, such as moving supplies, tenant insurance that they're going to tag on to the customers who are renting units from us. Now, when you look at the self-storage demand, this is where it gets really interesting. So when things are going well, Americans need self-storage. Businesses need self-storage. People are moving around, people are doing renovations, people are starting up new businesses, and that's when people need self-storage. However, during the recession, when times are going tough, people are getting divorced, people are going through evictions, maybe people are even declaring bankruptcies and getting their houses repossessed. But guess what? When people get their houses repossessed, they don't want to give away their treasured belongings. If they have their babies' pictures from when they were young, where they have their grandparents, wedding ring or any of that, they need a place to store them still. If they're moving, they're downsizing from a massive house into a little apartment, they are not going to get rid of their personal belongings, right? So that's why you see an average length of tenancy when it comes to self-storage. Residential, we're able to see a steady 16-month of average tenancy. Commercial tenants, so any small businesses, they usually stay around 21 to 22 months on average. When it comes to managing turnovers and dealing with tenants who are not paying rent, or that we have to essentially put a double lock on there where we have to evict them, to turn over a unit like that in self-storage, it takes 30 minutes for it to be rent ready. But when it comes to multifamily, it takes at least 3 weeks for you to be able to get the property to be in a rentable condition, right? So the difference here is absolutely massive. And the fact that you don't have to worry about chipped paint, you don't have to worry about new appliances, you don't have to worry about new flooring. It's just sheet metals on concrete. You go in with the Dyson, you clean it up, boom, it's ready to go. It's back online. For multifamily, that's a completely different story. Now, the exit strategy that we have is the fact that we can sell at different points of exit, as I mentioned before. The fact that you can sell it as a piece of entitled land to a developer, you can sell it as certificate of occupancy, or you can sell it as stabilization. As where we stand right now, our plan is to hold on to it for 5 years. So that's 1 year of construction and around 3 years to get it to stabilization. So 3 years of operation. So in total, that's around 4 years of the total project hold period. And we're budgeting as a 5-year exit. But at any point in between the 5-year period, let's say if a developer comes in and they're saying, hey, we love the site that you have, we're willing to offer you this amount of money for it. If we're able to achieve the same amount of return, the same amount of internal rate of return. So let's say we're able to achieve a 20% IRR in 2 years instead of 5 years, we're definitely going to take the 2-year model. So we're able to pay back our investors and continue with the next project. So because we're uniquely positioned as a mid-sized operator in the self-storage space, gives us a lot of flexibility in terms of who the end buyers are too. So we're talking about the big fish. If you use the small fish, big fish analogy, we could be acquired by a big fish. What does a big fish look like? We're talking these publicly traded REITs. We're talking about Blackstone. We're talking about these private equity groups such as Mary Hill Capital, and all of these self-storage institutions that are in the space for market consolidation. And that's very much been happening over the past 20 years. If you look at the self-storage ownership from 2003 all the way up to this year, we're seeing a drastic incline of REITs and public companies who are getting into this space. What that means for the private investors is whoever bought self-storage or developed self-storage over the past 20 years, they're seeing way bigger sales and offers coming from these bigger companies. So that's why you see these private owners are actually leaving the space, because they get to sell it off to these massive operators and massive companies. So you see institutional investors on the rise, private equity groups are on the rise, and the private investors are the ones that are selling them off. We also saw Life Storage. This recently happened. It got sold to Extra Space for $12.7 billion. Public Storage is out here buying portfolios after portfolios. Edison Property sells Manhattan Mini Storage for $3 billion. Blackstone buys Simply Self Storage. Bill Gates becomes part owner of one of the country's largest self-storage operators. So all of these institutional investors with a lot of backing, they see self-storage being an extremely recession-resistant asset type, and that it's an extremely easy real estate asset type to hold on to and manage. That's why they're getting into the space. Now, what's unique for us is the fact that we're not too small, but we're also not too big. So we are actually in a position where mom and pop operators or these smaller individual investor that's looking to get into the space, they will actually benefit from buying from us as well. So once we have a stabilized asset, we are even in the position to sell it to one of these mom and pop operators that's looking to get into the self-storage industry, but don't necessarily have an access or the resources to do the kind of due diligence that we are doing, but they're simply just trying to get into the industry. So we have the option to even position ourselves to sell it to a mom and pop operator. What you can expect as an investor into the deal. You receive monthly updates, monthly financials in terms of where the project is currently at, how many units we have rented, how many move-outs we had. But when it comes to the actual returns, the capital payback, the preferred rate of return, the carry interest, that's all paid out as sale. So as I said, if you're looking for a cash flow play, this is not an opportunity for you. This is purely focused on building out the equity and trying to double your equity and grow your equity as much as possible through this development process. We're going to issue K1s in March, every single March, just in time for your tax filings. So this is what you can expect as an investor. How much will the property be worth, you might be wondering? Based on the projection that we have, based on the projection that our property manager, CubeSmart, has provided, we're estimated to hit a net operating income of just over $1 million per year at the end of year 3 of operation. So what that means for us as property owners is at a 5.5% cap rate, that's going to put the valuation at around $18.9 million. However, the likely scenario is actually running at a 4.5% cap. That would mean our property value will be around $23 million. What that means for the investor is you're able to see a 24.1% annual return on your money for the 5-year period. So instead of doubling your equity, which is extremely conservative, you're likely going to 2.7x the equity that you have put in. So if you put $100,000 in, you likely end up with $270,000 at the end of the whole period. And that's a very likely scenario because that's what we're seeing being the cap rate that's trading, that's these facilities are trading at. So I'd love to give you an idea of what the contingency plan is and everything that could possibly go wrong with this project, just so you can understand where the worst case scenario is and how we're planning to mitigate it. So natural disasters, we look at all the different types of natural disasters that could happen in El Paso, Texas. And we found that El Paso is just like a desert, right? So it has a very low chance of earthquakes, tornadoes, volcanoes, or hurricanes. It's extremely dry and it has lower index of natural disasters compared to Texas and compared to the rest of the nation. Overbuild, that's very much a concern that a lot of these self-storage developers will have when they're building a new project. However, we realized that there's an excess demand of 739,000 square foot based on the current saturation and population density. So in theory, we're only building about 80,000 square foot. So in theory, this market can support 8 other facilities like ours. So that means if anyone that's in this call right now, you decide, hey, I'm not going to invest with Martin and Lynn, but I'm actually going to build one myself. We totally welcome it, right? This market is so underserved that this market can support 8 other facilities, just like ours, just like the one we're building. And we're still barely meeting the demand this market requires. Let's say the economy crash. Let's say the interest rate goes out of whack, the real estate bubble burst, and everything just goes to the crap. So in the 2008 recession, we studied that self-storage was actually the only commercial real estate asset class that didn't have a negative quarter. And that's very much because when things are going bad, that's when people need self-storage even more. That's when people are putting their stuff. That's when people are downsizing, closing down businesses, but they still want to hold on to their inventory in self-storage units, right? And lastly, if our project takes longer to lease up, we're not able to refinance, or the REITs just completely stop buying altogether, well, guess what? We're just going to hold on to this self-storage facility as a cash flowing stabilized asset because they perform at over $1 million in net operating income. This is a cash flowing property, just like a multifamily that some of our investors on this call currently have, but it's extremely maintenance free. You don't have tenancy laws to worry about. You don't have toilets that you have to fix, sheet metals and concrete, and it's professionally managed by a real estate investment trust. So that's the beauty of this project. That's really the end of our presentation. Definitely would like you to engage and invest in this project. If you determine that this is the right opportunity for you, you can scan this QR code. That's going to take you to the page where you can reach out to us by email or by phone. We definitely encourage you to contact us before the spots are filled. We're hosting webinars like this, but at the same time, we're pitching to institutional investors. We're pitching to other investors that we worked with before. So we definitely expect this to be filled up as soon as we see here. So yeah, that's the end of our webinar. Do we have any questions?
Yeah, thank you for sharing, for going through all of these details. Could you maybe just give us more information about the timeline of this project and what is it projected to be like in phases?
Yeah, so the timeline that we have here, this is where the beauty of working with our consultant comes in, is he's able to draw up this entire process. So as soon as we finish closing on the land, we're looking at a 4-month period to get the building permit. So that's when we're working with the city. It's already fully entitled, so we don't run any entitlement risk. So it's going to take around 4 months for us to get the building permit in, to get it approved by the city. And then from there on, we're able to get construction financing, and that's when we can start the construction process, because that will be considered shovel ready. The actual construction itself, it should take anywhere from 10 to 12 months to build the facility that we're planning to build. It's extremely fast because it's a self-storage project. There's very few moving pieces we have to worry about. So it's going to take around 10 to 12 months to build. And as soon as that's done, we're going to apply for the certificate of occupancy, meaning that we're fully ready for operation. We're fully ready to open doors and start taking tenants in. But while way before that, halfway through the construction, that's when our property manager is going to come in, fully brand the facility for us, plan out the business plan, plan out the lease up plan. and start moving into our units. The rental office, setting up the rental office to prepare us for the grand opening. So that's roughly what it looks like in terms of the construction. The actual lease up period, the revenue projection that we have run, it's that we're able to hit stabilization, which is considered 85 to 92% occupancy by the end of year 3 of operation. So given a year of construction and 3 years of operation for us to be stabilized asset. So that's why we budgeted 5 years in total, just in case that we have a lot of wiggle room to play with here.
Awesome, thank you. Yeah, I mean, if there's any more questions, you guys can add them in the chat. If they don't come to you and they come in later, there's all of our information on this last slide. You can email us or even text us. Honestly, we're very available through text too. And we look forward to hearing from you guys.
Yeah, and I just want to share the investor portal that we have as well. This is what the experience looks like. And I'll make sure to tag this along in the link of this webinar as well. Here, let me just put it in here. Well, what it looks like is this is where we shared all of the information about the deal. You're going to see similar pictures from what I shared with you in the deck. And you're able to see all of the due diligence that we have completed under the tabs documents. That's where you see due diligence, the track record that we have, the financial, the investment summary, as well as the comparables. We even have Marcus and Millichap send us a long list of Texas self-storage comparable sales. So every single self-storage facility that were sold between 2021 to 2023, ending this June. So this is where you're going to have a lot of due diligence items in here. And whenever our investors are ready to make a soft commitment, meaning that, hey, like, I think I like this project. I would like to commit, let's say 200,000 of my money. You simply create an account here, follow the steps here. These are all of the information that's required by law that we need to collect from our investors. And then from there, it will be a very smooth process. We'll send over the securities documents. We'll send over all the documents for you to review and sign. From there, we'll send the wiring instructions of how to deposit the money into the limited partnership bank account. So very streamlined process. We're going to share all of our updates here. And by having an account on this portal called InvestNext, that's where we're doing the communication of the deal specifics only for our investors. These webinars that we're currently doing, this is purely for prospects, right? But once you're fully signed up as an investor, that's where you're going to have your own dedicated account, your own dedicated platform to really track the performance of your investment.